everyone, and welcome to chapter 18 and 19, which is going to be looking at the international side of our economy and exchange rates. When we look at exchange rates, you'll notice that companies will be influenced by exchange rates. For example, if you read something that says a strong dollar hurts McDonald's profits. If we look at the recession of 07 to 09, this was a period of prosperity for McDonald's. Its success continued into 2010, but with limited growth in the U.S. market, McDonald's has been expanding into foreign markets. But since McDonald's revenue comes from many different currencies, its revenues and profits are going to be fluctuated based off those currencies. A lot of people don't realize those currency fluctuations can really influence the strength of the dollar. McDonald's profits. For example, McDonald's the revenue measured in local currency could be less than the revenue in terms of they're collecting. And since the value of the dollar has increased, converting foreign currencies to the dollar has yielded fewer dollars, which is a big challenge. So we're going to look at an economy with a couple different terms. An open economy is when an economy interacts with other countries. A closed economy is when an economy has no interactions in trade or finance with other countries. So their borders are closed to trade. Now the balance of payment is looking at the record of countries' trade with other countries in goods, services, and assets. Now when we look at the balance of payments, we're going to be looking at the current financial and capital account. The current account is looking at goods and services of a country. And you'll notice in the US that we have a negative balance on goods, but we have a positive balance on services. The one thing the US has a lot of is they do focus on a lot of service industries, and the service industries is very important to the US economy. So we always are running this current account deficit. And this current account deficit is illustrating to us that we have challenges in our economy. Our financial account has a positive number, which is different than we mostly think. But the current account and financial account, what is the discrepancies in this? What could be the future? If you look at China, you'll notice a current account surplus. But with the financial account, they might have struggles. So what is the current account looking at? The current account is basically looking at the balance of goods and services. So now let's take a little bit more focus on this in chapter 19. And 19 is going to be looking at the international economy. And you're going to be looking at some deals that happen with exchange rates and how those goods and services transfer over. For example, in 2009, Airbus delivered its first A380 jumbo jetliner. The sale was good news to Airbus, but had a downside. Even though Airbus is a European firm, the worldwide aerospace industry conducts business in US dollars. So now that's going to create some confusion. Watch this. Between 2001, when Air France agreed to buy 10 A330 jetliners from Airbus, and when they were delivered, the euro appreciated by 60% against the dollar. So when Airbus converted the dollars from Air France, it received fewer euros. Now in 2011, the European Aeronautic, or the EADS, announced a 41% decrease in profits just because of the exchange rate. The exchange rate created a lot of challenges for this economy. Now, there's a couple different types of exchange rate systems. You have a floating currency, whereas an exchange rate that always has a currency that's fluctuating. And it's based on the role of supply and demand. And supply and demand determines the price. A fixed exchange rate system is looking at an exchange rate system that has an exchange rate that does not change as they keep their currency fixed. The US is a good example of a floating exchange rate system, whereas a fixed exchange rate system would be focused on like China. And China has a fixed currency, and it creates a lot of challenges for other countries, I should say, because China's exchange rate doesn't change, which creates the ability for them to have maybe a lower exchange rate or value, and it will stimulate their buying power. But this was a good analysis of chapter 18 and 19, but I look forward to your effort.